Friends, in this video for iThought Advisor, I am going to talk to you on the topic, the rush for the exit gate. We are seeing very large institutions like SoftBank, like American venture capital firms, rush to the exit gate in some of our marquee listed companies which had blockbuster IPOs in recent years. We are seeing the huge blocks getting traded in Nykaa coming from very prominent venture capitalists and also large investors. I saw one investor sell for over 1,000 crores. We are also seeing SoftBank sell almost its entire stake in Paytm. You're going to see this happen in delivery. You're going to see this happen in multiple companies which did their IPOs in the last 1 year. These were hugely successful IPOs. Many of these were seeing a very high demand from investors. I know you're going to pull up Paytm as the exception, but the others were very well received, and today the shares are being sold well below the IPO price at a discount to the market price in large parcels to willing buyers. Now, for every seller, there would be a buyer, right? So we can always advance the argument that if these guys are selling, somebody is buying it. How come they are buying it? Just look at the profile of the buyers and you will have your answer. You will also need to think about whether there are any incentives for the buyers to buy these shares. Whether they are buying them out of conviction or because they want to have exposure in our country or because they are incentivized. It is not uncommon to incentivize buyers to buy stocks, and if those buyers are foreign entities, we don't know. We simply don't know what is the decision lever. Domestic entities are nowhere near buying these shares, and that is an answer to the question whether the buyers are incentivized. You are not seeing mutual funds go and buy any of these shares, which is a telling statement. It's more than a statement. It tells you that these shares can be sold only to certain type of buyers who would be willing to buy them subject to certain incentives. It could be a discount, a very sharp discount to the market price. It could be something else also. So, the fact that a stock falls a lot and a big lot is bought is not a reason to cheer, it's a reason to be cautious. That's the simple point that I want to make about these large parcels in very popular companies. One thing that I have learned from experience, most IPOs go below their issue price. In fact, most IPOs go significantly below their IPO price. I have seen companies go to as low as 15% of their IPO price. I have bought such companies. Today, those companies are many hundred times of that low. So, it's not that the company is a bad company, but the IPO happened at an aggressive valuation. Nobody made money. Because nobody made money, everybody got frustrated, and all those who got frustrated came and dumped those shares. When they dumped those shares, the shares hit rock bottom valuation. And at that rock bottom valuation, they were attractive. So, the lesson from what I just told you is that don't catch falling knives, let them settle, and once they have settled and fallen to the ground, decide which are the knives which will once again sharpen themselves and shine in the future. The rush for the exit gate should not make investors like us chase those who are rushing to the exit gate to grab their wares. Let them take it out and dump it wherever they want. Keep watch. Understand the businesses. Be very, very tough on what valuation you are willing to give these companies. Be strict in how much you are willing to pay, and be patient in how long you are willing to wait. That in essence is how we should approach last year's IPO companies and this year's IPO companies. The wait to buy them could be much longer. Thank you for watching this video.